Okay, so we're going to go through year 1 of in-class exercise 1. Okay, so what Anna is going to do, she's going to email you this Excel template. Okay, not now, tonight. Okay, and so we'll go over this using this template. And if you say, oh man, that's super helpful, I wish I had this before, well then you have it now. And if you say, you know what, that thing confuses me, I'd rather do it my way, then that is fine too. Okay? So it is important to me that you don't just use this thing as a calculation tool and assume that it'll get you the right answer, but that you know how to calculate the provision yourself. Like, remember when I was talking when Lee was here and I said I deleted a couple formulas, right? Like, if I did that the same thing to you and you had to piece it back together, I want you to be able to know how to do that. Okay? So it's not about the spreadsheet or the formulas or whatever. It's about knowing what it's doing and why, so that if something's not working right, you can go diagnose it and fix it, right? But it's not fixing Excel, it's fixing your journal entries and your calculation. So here's the way I show this in this Excel format. And I have to say, just to give you kind of a heads up, most people, and Anna, you can tell me if I got this right, most people tend to use this for the rest of class. For the final. Yeah, that's pretty common that people use this. But again, you do not have to use it. You can write it out by hand if you want. I don't care. It's whatever makes sense to you. And so as I was walking around, I saw a lot of you guys coming up with your own Excel versions of how to calculate this stuff, and that's fine, right? Do whatever makes sense to you, but this might be a somewhat structured or organized way that you could follow as well. Okay? You'll see that this file has a bunch of tabs, so we're going to start on the payable tab, but it has a deferred roll forward, which we'll get to in a second. It has an account roll forward, which we've been talking about in class so far tonight. So we roll forward our accounts from last year to this year, and it has a rate rack too. So this thing has kind of got it all, right? But again, you know, you change one number in here, or you delete one cell, and like the whole thing will be pound ref, and it won't make sense, and you'll be like, your schedule sucks, right? And my comment to that is, I don't care. Okay. So the way the schedule works is, as you can see here, it is debit credit. Okay? So everything that we're going to show is going to be in debit credit format. And so much like the first night of class where I was taking individual assumptions and turning them into balanced journal entries, that's kind of how this schedule works too. So if you think of each of these columns as a tax account, think of this as the provision. And this is your DTA or L. And this is your payable. And if you're thinking, well, why don't you just call them those things? Well, then you could change the schedule if you want, right? Make it your own. I don't care, right? Do whatever you want with it. But think of this as provision, deferreds, and payables. So if I had 10 million of income, then I would have an increase to my payable. So I put it as a credit, right? I have a credit to my payable. I don't have any deferreds related to just having book income. So, you know, I have a step 1 item. I don't have a step 2 item for my book income. And my step 3, my balancing entry for book income would be a debit to my provision for 10 million. Again, this is pre-tax. I haven't gotten to the tax rate yet. But you can see how just that I have a balanced journal entry. That's one way to use this schedule. The second way to use it is, if you don't want to go line by line and do that journal entry by journal entry thing and go slowly, well then you can hop right down to the answer. And you can come down and say, well, this is my total payable, that's step 1. This is my total deferred, that's step 2. And that must be my total provision, right? And I've calculated them straight down the columns, right? I can do my step 1, and then I can move on and do step 2. And you can work off the totals like we do most of the problems in class, okay? So you can do it one way, you can do it the other way, you can do it both ways, right? It's like a Ginsu knife. Okay, so let's go through the problem the way I think most of you will think of it, which is to go through all of step 1 first to do the payable, then move on to deferreds and do the deferreds, and then come up with our total provision. Okay. So we've got our 10 million of book income. Because that's profit, and that's going to cause us to owe payable. We have a credit in the payable. We have a debit and expense. Meals and entertainment. It's a perm add back. That means we need more payable, more expense. Debit in the expense, credit the payable. Non-deductible penalties, same thing. More payable, more expense. Bad debts. We have an add back to bad debts. So we get a future deduction, but it's an add back now. So we have more payable. There's no expense because we have a DTA, right? This is going to be a DTA once we tax affect it. Depreciation. So our depreciation is more for tax than it is for books. So that means our taxable income is going to go down. It means we have less of a payable. So here we have a debit to payable and a credit to deferred. Okay? So this might be screwing with your mind a little bit because a deduction looks like a positive number in this column when normally you would associate deductions with amounts that are bracketed. Right? So we're not using absolute dollars. We're using debit, credit. Okay? Debit, credit. And if later you reflect on this and you're like, your schedule's totally confusing with this whole debit credit thing, I don't care, right? If you want to do it differently, that's fine. Throughout the schedule, it'll be debit, credit. Okay? Debit, credit. Okay, so we have a $300,000 additional deduction, which means we need less payable, so we have a positive number. Flip side of that will be a DTL, so we'll have a credit to our deferreds. So you can see with this schedule, every little assumption we make, it always balances. There's always a debit, there's always a credit. Numbers are kind of nice and neat. It's all good, right? So we get to taxable income of 9,805. So that is a taxable profit, even though it's bracketed, because again, it's debit, credit. Okay. Apply our blended rate of 855. So that's taking our average of apportionment rates and tax rates. It's coming up with one blended rate. So this 838, that is our tax before credits for all of our states. So we're clear, Anna will send you this exact model with these exact numbers, and so you do not need to scramble and write all this down. The better thing would be to just enjoy and try to absorb. Okay? So we're using a blended rate.
So rather than just get on the blended rate, rather than just adding the state rates together, you have to add the apportionment. You have to multiply the apportionment.
Apportionment times rate plus apportionment times rate plus apportionment times rate. If you wanted to, you could take this section of the provision, the state section, and break it out into individual states. If you wanted to do that. You're like, no. I don't want to do states at all. Hop came up with 9%. Well, if you take 8.5 times 70 and 8 times 0.15 and 7% times 20%, you should get 8.55. That's how Sam got that somehow. Okay, so my tax for all my states before credits would be this 838, 328, and I have a Michigan credit. So my Michigan credit is going to permanently reduce the amount of tax I pay in these states, right? Namely Michigan. So my Michigan tax is going to go down, and if I'm doing a schedule based on debit credit, that means my payable goes down. If my payable goes down, that's a debit. This has nothing to do with the temporary items, so there's no deferred movement. It means there's a credit entry to the provision, right? Perm item, that's a good guy, means debit payable, credit provision. We good? So right there, if I summed up my if I sum up my entry right there, it'll sum to 0. Boom. My entry balances. I'm done with my state provision. Right? That was so easy. So if we have 8 of those on the exam, you should be able to do them in like 3 minutes apiece. You'll be done in half an hour. It's going to be great. Okay? All right. So we did our state provision. That's the easy part. Okay? Now we're going to come on and do our federal provision. Same thing. Debit, credit. Start from the top, go all the way down. Everything is the same in the federal column with the exception of this line. Okay? You will probably have nightmares about this line. Okay. So the 10, the 40, the 45, and the 300, those are all the same as the state. The only difference is this federal deduction for state tax. Okay? So, when I was young within the firm, I remembered I've spent so many hours just kind of racking my brain about the mechanics of this. And again, as you do a provision, if this schedule confuses you, do it differently. Right? Do it however it makes sense to you. But we know, so if we do step 1, 2, and 3 for federal, when we're doing our step 1 for federal and we're on a current deduction method, then whatever the state payable is, this state payable right here, we get to deduct right there. We get a federal deduction for the state tax we owe this year. So we are going to debit our federal payable because we're going to owe less federal tax because we get a federal deduction for state taxes. Right? That part is usually the easy part. Yeah? Okay, so then we finish our federal step 1 by going down to taxable income. We take our R&D credit, and we get our 3105, which is our step 1 for federal expense. Catherine? You're segueing right into the next topic. Just hang tight for like 10 seconds. Okay, so we did, when we're doing our federal provision, we did step 1. Included in step 1 is when we calculate our federal payable, we took a federal deduction for the state tax we owe this year. That's the red circle with the red line. Dig? Okay, now we're doing our step 2, our deferreds. So we know we're going to have a $45,000 future deduction. We know we're going to have a $300,000 reversal of that tax depreciation. Now we get to the federal effect of state, right? And this is like, ugh, what is this? Okay. In the future, the state has a DTA or a DTL. What is that? Cindy, what is that? DTL, right? Okay, so what's going to happen when we have a DTL? What will happen next year? Now, what happens next year? No, the other now. Not now. Right now. So next year, let's say all our deferreds flip. What's going to happen in the state? What are we going to do with the state? Are we going to pay them tax or are we going to save tax? We're going to pay them. Right. Wait a minute. That's good. You weren't listening to the other guy. Okay, we're going to pay tax in the future. If we pay tax in the future now, what happens on our federal return? We're going to claim a deduction next year when we pay state tax next year. So this DTL represents a future tax, and so that means this DTA represents a future deduction. Right? If we're going to owe state tax in the future, if our state deferred, they're telling us we're going to owe state tax, then correspondingly, we're going to get a future federal deduction for those state taxes. Because whatever happens for state tax, there's a federal effect. It's just a matter of which direction it's going. Okay? And the signs are what will screw with your head. Okay? So if that's a credit on the state side, it'll be a debit on the federal side.
So on the state side, it's a DTL, and it's still a DTL on the federal. It's just,
No. It's a
it's a
DTL.
It's going to be a DTA on the federal?
It's a state DTL, because in the future, if all our DTLs flip, we're going to cut a check next year for 21 grand. If that happens, the next year we will get a federal deduction for 21 grand. So it is a DTA. It is a future deduction of 21 grand. Okay? State DTL means a Fed DTA. State DTA means a Fed DTL. Okay? It's opposite land. If you don't like this, wait till the next class. I'm going to have Quinn teach. Alright. So, we did step 2 by calculating all our deferreds, but just to complete the picture, in general, remember that we said that the rule for Fed effective state is, if we have a state provision of 818, we know that over the life of this company, the federal deduction we're going to get for state taxes, Bihan, how much do you think our federal deduction for state taxes ever will be? It's circled in green on the bottom, on the right, where my cursor is. 818. Whatever we say we're going to accrue as a provision for state tax, ultimately one day we will deduct that for federal tax purposes. We're deducting $796 now. We'll deduct 21 in the future. In total, we will deduct 818. Okay? What I would encourage you to do is not focus so much on the fact that this line in orange is the inverse of this line in orange. What I would suggest you do is focus on just keeping steady on, step 1, step 2, step 3. Get those right. Get step 1, 2, 3 right, you'll be fine. Don't get all hung up in the, what is the spreadsheet doing? Why is it a negative? Don't do that. So when you're working on the homework and you're like, I don't understand, why is it negative? And is this one a positive or negative? I hate this. Don't do that. Think step 1, 2, and 3. Okay? Don't get sucked into the Excel mechanics. But again, once I did that, you'll see that every row on this schedule, it always balances. And so my journal entry down here sums to 0. Right? My provision balances. My state balanced, my federal balanced. If I wanted to go slowly and do journal entry by journal entry for every little assumption, I could do it that way. I could look at the schedule and say, that makes sense. Book income, perm, temp, I got it, credits. I could look at it that way. Or I could look at it in total. Okay? All right, I feel good about that. This might be the only one. Okay, the second tab in this workbook. So now this is like a guided tour of the workbook now. So from this page, by the way, you could kind of be done. I mean, we could hop right to our rate rec and be through. This page like kind of does it all for you if you wanted to. But I'm going to show you the other tabs in the workbook just to be thorough. So you will see that as these provision examples get harder, especially as we go to multiple years, we're going to start rolling forward our deferreds. Okay? So for example, at the beginning of the year, we didn't have any future deductions for bad debts. In the current year, we had an add back. So in the future, we're going to have a deduction sometime in the subsequent year or two for 45 grand. So when we get to next year, we're going to start with 45, and we're going to adjust it and get to a new ending balance. Right? We're going to roll it forward. Every company that has a provision has a deferred roll forward. Okay? They all look different, but everyone has something like this. Okay? So we're going to create something like this. So all this will do is aggregate all of our deferreds. We'll just have a nice little schedule that explains how we get from beginning to end. We'll multiply them by the tax rate and add any kind of like credit carry forwards, that sort of thing. But this is just a nice, neat way to package up our deferreds at the end of the day. And then we characterize them as current, non-current. Okay.
Why do you have to break it up? I mean, I know current being the 12 months and then non-current anything beyond that, but why the need to?
Okay, we'll talk about that a little later if that's okay. So for the moment, know that we have a tab that rolls forward our DTAs, and because we started with 0 in this example, we have nothing over here. We're building our DTAs, and these are the ones we have at the end of the year. Okay? Because you paid so much for this model, you will find that it's even linked. So, like we put in the bad debt. That's what that was? Yeah, bad debt reserve. We input that amount on the payable tab, which is that first tab I was scribbling on. And then this thing automatically knew, well, if I put something in a certain place in that deferred column, it should build a DTA in my roll forward. Okay? So again, if this formula wasn't working, right, if I deleted this, when I get to my rate rec, it will not work. This provision will be out of balance. So you would need to know, oh man, like where's this thing falling down? And you would have to figure out, gosh, the change in my current deferreds, it's 278 here, but yet when I go over here, it's only 233. How can that be? Right? That's not right, because the change in my federal deferreds has got to be the change in my federal deferreds, but it's not working. And the answer is because I deleted a cell. When I put it back, it ties perfect. Okay? So it's as simple as that. You guys play around with this and try to make sure you understand it and change numbers and all that, but know in general that that first payable tab, this tab is basically where the inputs go. To the extent you don't modify a lot, the rest of it should flow fairly well. Okay? So there's a federal deferred roll forward, there's a state deferred roll forward. On our schedules, the only difference is the federal has this federal deduction for state tax thing that we were just talking about. Right? That was the blue circled thing on the first tab. That's the, if I have a state DTL, I must have a federal DTA. Right? That's all that's doing. Okay, accounts. All right. My beginning balance is 0. You can see I have all these columns for my accounts. I'm going to explain how I get from 0 to my ending balance. 0 to ending balance. All right? That's what we're going to do. So, the way this schedule is shown, and you can do this in a lot of ways, this is shown as federal, separate from state. This would be step 1 on the federal. that would be step 2, and this would be step 3. So remember those numbers, 3181, 3187. If you go to the payable tab, 3181, 3187. Right? So you do this tab, you get a balanced entry. All that account schedule does is take this entry off the bottom of this tab and stick it in a different format. Right? And that's all it does. State thing, we do the exact same, right? Step 1 from the state, the 796. Step 2, that's our 21 DTL. You guys probably have that number memorized by now. And then that is step 3. That is our state provision. Each entry balances. It's telling us how we got from the beginning of the year to the end of the year. Okay? We made payments, because I told you we made payments, so we're going to debit our payable. These are debits. And we are going to credit cash. Okay, so that entry balances. So now we can get to the end of the year and say, hey, we got a receivable. And we should think to ourselves, does that make sense? Are we owed money? And if we did a proof, if we did a tax return the next day, the tax return should reflect that we get a refund. For states, we have a payable. We owe state tax. And if we filed our state tax returns the next day, we should have to cut a check for 406. This row is merely a total, a summation of the first 2 columns if we want to aggregate our payable and receivable. This is our cumulative deferred. And if somebody said, gosh, is 100,000, is that right, 103? That one's a little tougher because you'd be like, well, I don't know, I'd have to go look. Because that's an aggregate of all the deferred taxes you have for both state and federal. So that's where you'd have to go back to your deferred roll forwards and be like, well, I don't know. This schedule tells me I have 81 of Fed. I add state, I got 103. I know you're seeing the schedule for the first time, so you don't have a handle on the flow necessarily, but you'll see that the deferred roll forwards will sum up the deferreds, and so it should tie to the account roll forward. Okay? So that is the easiest account roll forward you will ever see. Okay? But that's what we want you guys to do. You do a provision, you book the journal entries, you roll forward the beginning of the year accounts to the end. All right? Okay, last tab we're going to go over here. This tab does 2 things. It has, when you look at a company's 10K and you look in their tax footnote, the first table you see is the current and deferred expense table. That's what this is. Okay, this table right here, that's current and deferred expense. Here's current, there's deferred. So these numbers probably look familiar. I owe 3.1 currently. I'm going to owe 81 in the future. My total provision is 3.187. I pay 800 now. I'm going to have to pay 20 more later. My total provision is 820. Okay? So you probably remember those numbers were coming off the bottom of that payable tab from step 1, 2, and 3, right? This is step 1, that's step 2, that's step 3. It's like we're doing the same thing 3 different ways and sticking it in different formats, right? Okay, so that tab in the top will do that. And then there is a rate rec at the bottom. Okay? Now here's the twist with the rate rec. So we've listed all our perm items. We have PBT, we have our perms, we have another perm for our credit, and then we have our state tax. But let's say that we forgot that penalties let's say the link wasn't working because I was incompetent and I gave you a schedule that didn't work. So if I deleted that, this thing would still work because there's a formula in here that will say, well, I know what the total answer is. It's this. And the numbers above didn't get me to that answer, so I'm just going to plug it. Right? That formula right there, that's in orange, that's just a plug formula to get you to the answer that you already shown above. So if you have a number in that row, you're not going to get like an A on your test. You don't want anything in other. Other doesn't count. We're explaining what our reconciliation is. We're not jamming our rate reconciliation. Okay? But if we put on all our perms and we get state tax right, boom, rate rec works perfect. So the 405285, that's the sum of these two guys up here, 405. And it's also, if we went to the payable tab and we picked the Fed and state provision, it's 405. Yeah? Bingo. Okay, so as the provision problems get harder, if you want to use the template, great. If you don't, that's fine. I think the more you practice with this, the more you might find you can blow through problems way faster. And as you probably learned from some of the homework, it just takes a while to pound through these problems, right? It takes longer than it would seem like it should, but it just takes time to write all the numbers and kind of go through all the steps. But this will expedite that a lot. All right. Any questions on that?
So are we supposed to bring the laptop when we take the test?
We're supposed to bring the laptop when you take the test. What was our rule on that last year? Did we tell them they have to write it? Yeah, you got to write it. You can bring your computer and do it and then write it down if you want, but I wouldn't say that's a time saver. Yeah, as you can see, like open book, open notes, it doesn't really do anything for you when you're under time crunch. So, in the real world, I mean, provisions are done quickly. So, you know, you can open note, open book, but still got to figure out how to do it. Okay? Okay. So that was the solution to year one. Okay. Okay, now here's what we're going to do next. Okay, so we did our provision for year one. That was the easiest part. Okay, now we file the tax return. Okay, we file the returns, and this page in front of you, this is the basis upon which we filed our returns. Okay? The returns will not look like the provision. They never do. Right? So you calculated your provision, but now somebody filed returns using different assumptions, which means our payable was wrong. Our deferreds were wrong. Our provision was wrong. Everything was wrong. Okay? So we got to fix it. It's fine, right? We probably got close. And so we just need a little kind of nip, tuck kind of thing. And so,
Is this where you do your true-ups?
This is true-ups. Okay? So imagine that, we're at September 16th of year two, and we just filed year one's returns. So we're going to ignore the fact that we're most of the way through year two at this point. Let's just get year one right now. Let's true up year one. Okay? And the goal is going to be, if you could go back and take this accounts tab, imagine taking this tab and rolling it forward, saying, look, this is where I ended last year, but now I got to add some more rows in here. I got to true it up, right? Because I said I was owed $494 by the feds, but I really didn't end up with me owing $494. So I need a state true-up entry. I need a federal true-up entry. And the way to do this is to go state first, then federal, and calculate what was the difference between the numbers that you had at the provision, for example, the 796 of state payable. How did that differ from the return? That difference, that's a journal entry. At the provision, we said there was a 21 DTL. Well, now that we've filed the return, that detail's a different number now. So that difference, that's a journal entry. So we got to true up the journal entry that we booked at provision with an incremental journal entry to get our new balances right. Okay? So we got to true up state, we got to true up federal. So you guys can calculate what the differences in payable, deferreds, and provision is. Calculate the differences, and then book your journal entries. State first, then federal. Okay? Questions? All right, so here we go. So we're going to do return to provision. Okay? So our goals are to compare the provision to the return, come up with our differences, book our journal entries. So we're going to fix our payable, fix our deferreds, fix our provision. We're going to do state, and then we're going to do federal. It's like we did the provision all over again. And then we're going to go to our accounts schedule. We're going to take the balances we had last year, and we're going to fix them. We're going to roll them forward to what they should be as corrected. And then we're going to have new corrected year one balances. Okay? So what I've done in this schedule, I've taken the provision, the payable column, and I have put it next to a similar column for the return in order to capture the differences. So on the right-hand side of the schedule is the state, and then on the left-hand side is the federal. So let's worry about state. Okay? Book income, the same. Meals and entertainment, slightly different. The add back for meals and entertainment was less. Right? So we had less of a bad guy as part of the return to provision comparison. Depreciation. So we thought when we did our provision, we thought the tax depreciation would exceed book by 300. It only exceeded it by 200, so there's a difference of 100. Okay, that's a temp difference. So we thought we were going to save more tax than we ultimately did, but that just means we're going to have less of a DTL than we thought we would have had. Okay. We thought our state rate was going to be 8.5. Our state rate turned out to be 7.3. Our credits were slightly different, and ultimately our tax on a payable basis was different than by $111,648. Okay? One column is the provision, next column is the return, out comes the difference. This is just step one. Okay? So we would debit our payable by 111 because we thought our payable was 796 and it's actually much lower. So we would debit our payable by 111 and we would credit something else 111, namely provision, at least for step one. Okay? Again, we will send out the solutions. So understand, but don't worry about writing the numbers down. Okay, do we feel good about that? So now, if we were going to go to step two, forget federal, because I know you guys are all wondering about this Fed effective state thing. So stay on state. We got our payable figured out. So if we went to step two for the states, step two is deferred. Of all these differences in column H, which items are going to affect our deferreds? Depreciation. So if I go to my deferred roll forward for states, I thought last year those were my state deferreds. Right? In fact, it wasn't a $300,000 difference, it was only a $200,000 difference for depreciation, so I need an adjustment of $100,000. Okay, that is adjustment number 1. Adjustment number 2 is, I thought all my deferreds were going to be measured at 8.55, but in fact they should be measured at 7.3. So that is adjustment number 2. In total, last year I thought I had a state DTL of 21.8, but once I remeasure for the correct tax rate, and once I push through that $100,000 adjustment, tax affected, my deferreds are really only a DTL of 11,346. So the sum of these two entries, 10.4, that is a debit to deferreds, because I'm reducing my DTLs. I'm debiting my deferreds, and I'm crediting provision. Right? Okay, so step 1 was I had to debit my payable for 111. Step 2 is I got to debit my deferreds for 10. So step 3 is going to be I credit my provision for like 120. Okay? Seriously. So if I went to my accounts, I start with my beginning balance. I debit my payable 111. This is step 1. I debit my deferreds 10. You can't see. I'm going to hide some stuff here. So then this is step 3, the summation of that. Okay? That is my state true-up. So I took my beginning balance of 406. I thought I owed 406. In fact, I didn't. I owed less. And my assumption was that I paid any remaining tax that I owed. So I would debit my payable, and then I would credit cash. You don't see that on the schedule, but farther off to the right, there'll be a credit for cash. Okay? And so I've cleared out my payable balance. I don't owe any more state tax because I've cut a check right there. Okay? So my state payable makes sense. I started with 406. I trued it up. And then my state deferreds make sense because if you remember that deferred roll forward schedule, 11 was the number I was aiming for. Right? I started at 21, but then I trued it up for my rate difference and my $100,000 difference, and then out comes my ending balance. So now I can explain my state payable as corrected. I can explain my state deferred as corrected. And as a result of that true up, I have a state provision benefit of $122,000. So you can go to your boss and be like, hey, this is great. I got a benefit. You know, lower our provision, right? And their response will be, why don't you get it right the first time next time? Right? That'll be how it is. Okay, so step 1, fix the payable. Step 2, fix the deferred. Step 3, let the provision fall out. Make sure it balances. Roll your accounts from beginning of the year to the corrected, trued up end of the year balances. Got it? How did I get the payment of $294? Bless you. I just assumed that whatever tax I still owed, I paid. That's all. Okay. Federal. So I do the same thing on the federal side. I identify my differences. My differences are the same. Same perm difference, same depreciation difference. I have a little credit difference. But then I got that pesky federal benefit estate thing again. Right? Man, that's a headache. So, on my provision last year, I thought that I was going to be able to take a deduction of $796. Right? But in fact, I only paid $684 a tax, so I only claimed a deduction of $684. So that means that I'm out a deduction of $111,648. Right? So, on the state side, when I debited my payable for $111,648 and I credited provision, I have the exact opposite thing for federal. Right? So this entry right here, this means that I have to credit my federal payable. I'm going to owe more tax than I thought, right? Because I'm getting less of a state tax deduction, a federal deduction for state taxes. So I got a debit expense, at least for step one. Right? Less state tax, less federal deduction. Less federal deduction means more federal payable. More federal payable means more federal expense. That's step one. If I go to my deferred roll forward, this section should look exactly like the state. Rolling forward my beginning to my corrected beginning by just pushing through that 100,000, no big deal. Now I got the federal effective state again, right? The second part. I thought that the state guys were going to have a DTL of 21,803, which meant if they had a DTL of 21,803, I would get a federal deduction in the future of 21,803. We just did our state deferred true-up and we decided, no, there's only an 11,000 DTL. So that means in the future my federal deduction is only going to be 11,000. Right? So that means I got to push this through. I need to credit my DTA. My DTA is going down. I got to debit my expense for step two. Okay? So, step one, right? Figure out the effect to your payable. Step two, figure out the effect to your deferreds. Let the provision fall out. So, in total, we need to book an entry for this. This is going to be our step one. Our federal payable went up by 73 grand. So when we go to our accounts tab, there is an entry where the payable is going up. Step one. Okay, and the offset is expense. Okay, payable goes up by 73. Credit payable, debit provision. Now we go to our deferreds. We thought our deferreds, shrink it down one more. It's like impossible for you guys to see. We thought our deferreds last year were 81,619. But now we know that they're 50,279. So this change, that difference, that has got to be debit DTL, because we're reducing the 81 DTL, credit expense. We got to get the deferred we thought we had at year end of 81 down to 50. Debit DTL, credit expense. So when we go to the accounts, step 2, debit DTL, credit expense. Okay? So I assume that I paid, or I was actually refunded my federal overpayment. So my payable goes to 0. And I can prove my federal deferreds of 50 because that ties to my federal deferred roll forward. It ties to this 50. So my counts are rolling now, right? I got my beginning payable down to 0 through a true-up and a payment or a refund. I got my deferreds to the correct numbers through true-ups. And all the flip side of that accounting found its way into these provision entries. And in total, I have a, oops, I don't know what that was about. In total, I have a 79,000 provision benefit between federal and state on account of my true-up. Okay? So that's me taking my beginning of the year balances that I left off with last year, fixing them, clearing out payables for payments and refunds, proving my new balances. Okay? Okay, so if we were doing a year 2 provision, okay, because now we're on September 16th of year 2 when we're doing this. We just filed the return. We just figured out the numbers were a little off. We just went through our return to provision exercise, calculated the differences, booked our entries, cleared our accounts. But it's already September 16th. We're almost through year 2. Now we got to do year 2's provision, like right away, right? So what do? In a sense, we start over. We start over with another payable tab with all our year 2 facts. But now that you see these deferred schedules, it should make a little more sense that what we're doing is taking the same template, but now we're taking this section forward, right, for year 2. Right? This is year 1. We took the beginning balance, we fixed it, now we're on to year 2. Same thing on the accounts tab, right? This is year 1, we fixed it, now we're on to year 2, right? Let's book more entries. Let's get us to the end of year 2. Okay? The key is to separate these two things, okay? Fix year 1 separate from doing year 2. So when we get to the last part of this in-class exercise, it was the second year's provision. Okay? And when we look at the second year's provision, it's pretty straightforward. I mean, we have one more perm for meals and entertainment. We got some temps for bad debts and vacation. We got some credits. Pretty basic stuff. Okay? So after struggling through that true-up, you're probably happy to see a little provision like this again, right? Where you're kind of back in the groove of what we learned the first few classes. But this is just a basic provision. So our state entry balances, our federal entry balances, that pesky state thing here is always the flip of the signs down here. And you can rack your brain as to why that makes sense again, but it does. Our deferred roll forwards, they'll be flowing with the current year activity. And I'm going to hop straight to the accounts. Okay? So just like when we did the year 1 provision, I book my federal provision entry, and then I book my state, and I pull it right off the payable tab. Okay? I just do my year 2 provision like it was just a standalone provision. Okay? But now the zinger is, when I file my annual report for year 2, I'm not just showing my provision for year 2, I'm showing my provision for year 2 plus the effect of my true-up from year 1. So if I file a 10K for year 2, my expense that's going to be in my footnote, my expense is going to be all of this. Because fixing year 1 happened in year 2. Booking year 2 happened in year 2. So all that stuff that happened in year 2, we're accounting for in year 2, we're showing as a year 2 expense. So when we do our rate rec for year 2, not only are we reconciling the perm items that you see in our year 2 provision, which is namely the meals and entertainment and the credits, state credits, looks like there's no federal credit. Not only are we doing that rate reconciliation for the normal year 2 perms that impact our effective rate, but now we also got to capture this green shaded thing, because that's going to look like a perm item in our rate rec, right? Our provision changed compared to what we would have expected based on year 2 income, right? Our year 2 income had nothing to do with that provision true-up. That provision true-up, that's a year 1 item. So when we get to year 2's rate rec, it's probably built in the way we've shown it here. Yeah, it's built in. When we get to year 2's rate rec, you can see that there's a line item here for truing up meals and entertainment. And there's a line item in here for truing up credits. And buried in this state number is not only the state provision for year 2, but also the true-up from year 1. So if you looked at that $85,000 of provision, that 85 is the sum of the current year's provision of 36 plus the true-up from last year of 122. So when we explain why we have actually an $85,000 provision benefit in our rate rec, this is funny looking, right? Because we're saying, okay, we made $1 million, we would expect $350 of tax. But oddly enough, incremental to that, we're actually going to save $85,000 of state provision. And so somebody would be like, what? Like, how did you make $1 million and have negative state tax of 85 grand? And the answer is, I fixed last year because I overestimated. And now that I'm clawing that back, I get this benefit. That benefit is buried in that state line. The point being, this provision, this number here, this reflects my year 1 RTP plus my year 2 provision. Both. Okay? So the aha moment in this is, oh, when I'm doing my year 2 provision, it's both made up of my fixing year 1 and any provision effects of that, plus what I normally think of as my year 2 provision, just a normal standalone provision. Okay? It's both of those things. And the way to look at it, if you ask me, is to separate. Do this first. Figure out the fix to year 1. Do it independent of year 2. Don't worry about year 2. Then move on and do year 2's provision. Okay? Roll your accounts forward for year 1 and fix them. Stop, prove your balances, get all happy with year 1, understand what you did, and then move on to year 2. Okay? Alright, so how many of you could run home and crank out a problem like this with new numbers? I'm waiting for one of you guys to be like, let's just stay here and do it together. Okay. So I told you it'd get a little harder, right? This is a little harder. That's what I mean. But this, if you can get this, so go home and practice this. If you can figure this out, oh man, you're in great shape. Because what you see here is some repetition, but you also see it's the validation of how everything is a debit and a credit. It's a balanced journal entry. Right? Just like you could, if you wanted to slow it down and go through each row, okay, fine, that thing balances. All right, fine, that thing balances. You could go through the true up. All right, the true up, that row balances. I fixed my meals and entertainment. All right, what's the journal entry? I fixed my credit. What's the journal entry? I could do debits and credits. You could probably see with all the numbers we have going now, we could probably create like 50 journal entries. So if you wanted to do that, great. If that's the way like the debit and credit work for you, that's fine. Just going to be slow. But the point is just, systematically go through step 1, 2, and 3, balanced journal entry. Fix it, step 1, 2, and 3, balanced journal entry, and then move on to year 2, step 1, 2, and 3, balanced journal entry. Right? That's what we got to do. But do step by step. Don't try to do it all together and figure out why your answer doesn't make any sense, because it'll be really hard to backtrack to figure out where you went wrong. Okay, so as promised, we will send out the Excel file. The Excel file that we will send out will have 2 actual files. One will be the year 1 solution, and then the second will be the year 2 solution. The year 2 solution will include not only the year 2 provision, but also the true-up. Okay? The year 2 solution will look like what's on my schedule here. It will have the year 1 journal entries on the top, the year 2 journal entries on the bottom. So we will send you this exact file. Okay? For a price of nothing. Okay. You're like, can we talk more about what's ahead in the slides? Yes, we can. Okay. The last thing that we're covering in class tonight is disclosures. Okay? So you guys have been reading these public company 10Ks. Do they look familiar? Do they look similar to each other? Hello. Do they have the same tables in them? Do you think that is an accident? Did you do the reading? The reading told you what? What did the reading tell you about the disclosures, Philip? What's that? There's a lot to this class? There's a lot to disclose. The reading should have told you what to disclose, right? There are many required disclosures. Not everything you read in those public 10Ks is required disclosure, but a lot of it is. Okay? And the guidance is pretty explicit in terms of what companies have to say. Okay? So this slide and the next are specific disclosure requirements that every company will have. Okay? So for example, every company has to disclose their current deferred tax assets from their non-current. Okay? So Marianne asked this question like an hour ago. Current versus non-current. Okay. So if I have a bad debt reserve and it's a DTA, is that a current or a non-current? Why? Because the nature of the bad debt reserve. Ah, colder. Anyone else have a better? It's related to account receivable, which is what? A current asset. So if the accounts receivable is a current asset, the deferred related to it is a current deferred. Okay? So if I have a depreciation deferred, is that current or non-current? Okay? What if the asset's all going to reverse, the depreciation difference will reverse next year? Is it current or non-current? Still non-current, right? Because it relates to a non-current asset. Whatever the underlying item that the deferred relates to, if that thing's current, the deferred is current. Okay? That's the way you categorize those. Okay, so what if it's an NOL? What if it's AMD's NOLs? Oh, somebody other than Sam. Asmita, you look like you know the answer. What if it's AMD's NOLs? Do they call those current or non-current? And you don't know, answer it depends. Okay, she said it depends. What does it depend on? Vicky, what do you think it depends on? If you're going to use it next year. Okay? So let's say it's, that's good enough. If it relates to a current asset, it's a current deferred. If it relates to a non-current asset or liability, it's a non-current deferred. If it doesn't relate to an underlying asset, use common sense. When is it going to reverse? Okay? That's the answer. Okay. Allocation of valuation allowance between current and non-current, that's a confusing rule if we have time in another class. So somebody who's diligent, remind me in class number 6 to bring this up. When we review for the exam, ask me that question. Okay? This is the old rule, paragraph 42. This trips up people. Okay, you got to disclose different tax-paying entities in different jurisdictions. Okay, so one of the disclosures you guys often see is when you see the current and deferred table, you see Fed, state, foreign, right? People break those things out because the rule is you break them out. You got to show the components of the net deferred asset and liability. So I'll bet most 10Ks you have seen, if not all, and they better be all, have that table of what the deferreds are. What are the deferred assets? What are the deferred liabilities? People put that table in because the table is required. Carry forwards. There's always a paragraph in a company's footnotes below the deferreds table that says I have NOLs, I have credits, this is when they expire, blah, blah, blah. Right? People say that because it's required. Components of income tax expense. Okay, so we put in our current and deferred. We explain what the components of our expense are. This is kind of a class 5 issue. Rate reconciliation. Everyone's got to do a rate rec. Undistributed earnings. That's that thing where people say, I've got all these foreign earnings and I don't plan on bringing them back. I don't want to pay the U.S. tax. I didn't book a DTL for that tax, but I got to tell you that I didn't. Like everyone has that, right? More. Okay, this is all the FIN 48 stuff. You got to put in that reconciliation of your exposures, that roll forward table. That's a required table. You got to tell people how much would impact the rate if you reversed them. All these things you see in people's disclosure about the reserves are all required. Okay? This is important though, because a lot of times when you kind of grow up and you're working on provisions, like you don't know why people say what they say. You just assume they followed last year. But every public company that does a 10K and does a tax footnote, they work off of a checklist. And those checklists will be based upon the required disclosures. And companies will go through the list and be like, did I say that? Yeah, I did. Okay, next one. Did I say that? Yeah, I did. Okay. And I think, if I'm not wrong, one of your homework assignments was to take the Intuit 10K and take the disclosure requirement and write it next to the paragraph in their footnote where they said something and explain why they said what they said. So, for example, if they put a rate rec in there, you should have said, well, the reason they did that was this thing, this 740-10-50-12. That's why they put that in there. Okay? And if you see the paragraph on undistributed earnings, which Intuit doesn't have very much of, you would say, oh, the reason they do that is there's a disclosure requirement right there. Okay? So I want you to understand why people do what they do. Okay? They do it for a reason. Okay, so this I will make optional. If you're up for it, take the problem we did in class, the year 1, year 2 problem, and create the disclosures for year 2 as if you're doing a footnote for year 2. Okay? I'm sending you the solutions, so this isn't that hard. So I'm going to send you the solutions. Put together a footnote like you're a public company. Okay? Put together the tables. Do the current deferred. Do the rate rack. Do the deferred summary. Put the tables together as if we're doing a disclosure. And hint, you might need to do this on one of the exams. So it might be good to practice. Okay? So do it, turn it in. If we see you're having problems with it, we'll correct you and we'll set you guys straight. Okay? And that's the kind of thing we can go over in class 6 ahead of the exam. Okay? 10 steps. We have done the 10 steps to a provision. I can see you feel satisfied and energized. Okay, the next class. Okay, the next class is the hardest class. Tonight was a breeze. Okay? The next class is stock compensation. Okay? There are people in the big firms that make an entire career out of just next week's class. All they do is accounting for stock compensation. It is wild. And these rules came to be in 2006, and it created like an industry out of the 123R rules that came out. I mean, it is amazing how much time and energy gets thrown at the tax accounting or the accounting in general for stock compensation. Okay? So all of Class 5 will be focused on if a company has stock compensation, how do we account for it? It is confusing. Okay? So, read. Trust me, reading will help. You don't want to read? You want to be stubborn? That's fine. Trust me, there is not much reading here. The volume is low. But understand it. Understand why we treat some stock comp items as temps versus perms. The reading will tell you this. Okay? That is important. So we are going to send you out this 123R roadmap. We probably haven't sent it yet, but we'll send it tonight. So just like we sent you the Deloitte book on provisions, there's a Deloitte book on stock comp accounting. There's a tax section. So the pages we've highlighted here, it's kind of a lot of pages. But, man, if you want to make next week a little easier, read it. Because it may not make a ton of sense as you're reading it, but as you hear it in class and we go through some numbers, you'll be like, I remember that. Okay? And it'll be easier for you. The 10K that we're going to read for next week is Amazon. Amazon's 10K, confusing. Okay? They have a lot of stock comp stuff. Okay? They're one of those companies we talked about before where when you look at their income statement and their provision, the number is big. It's like hundreds of millions. When you look at the cash flow statement, you're like, how much cash did they pay? The answer is like nothing, or a very small amount. The answer, in terms of why, is stock compensation. Okay, so just like with NetApp, when we were talking with Lee, and we looked at her equity roll forward, and we saw those big benefits for stock compensation, you will see the same thing with Amazon. Okay? But Amazon has perm items for stock comp, they have temp items for stock comp, they have cash flow implications, they got things like credits that exist on their return, but they say they don't exist on their provision, all because of stock comp, even though credits have nothing to do with stock comp. So it's very confusing. We will talk about stock compensation and how it's accounted for, and then we will talk about their 10K at the end. Okay? But it's interesting. When you think, you look at like a Nordstrom's or a Disney, and they look pretty straightforward, honestly. Even like, you guys are just learning this stuff, but you kind of look at their footnotes, and you're like, I kind of understand what they're doing. This is not that hard. When you look at Amazon, I think what you'll find is, man, I don't understand what they're doing. And you'll start to appreciate the complexity with all the details that kind of go into the calculations. And it's not as intuitive as you would hope it would be. Okay? Reading their 10K is interesting too. I mean, they're just a really interesting business. And everyone assumes because they run the world that they just make gobs of money. And they're actually not as profitable as you think. So sometimes I like reading these 10Ks for that reason too. It's just interesting to get to know some of the other businesses and the level of profits, that sort of thing. Okay. All right, last piece for the homework. Write with words an explanation of 3 items. 3 items that relate to stock compensation that can impact your effective rate. The answer is there's way more than 3. So come up with at least 3. How do you think you can come up with 3 items? It rhymes with do the beating. Do the reading, for those of you who are slow. Okay? The reading has the answer to that question. Find multiple reasons why stock comp can impact your effective rate. All right? Anyone want to talk about anything else?
So on your schedules you had up above, that APIC column, is that for the stock option?
That APIC column is there for next week, yeah. We're ready to go, huh? All right, Mina.
Question, in some of the 10K on the tax window, they have disclosed the income before income tax. Is that required, or is it, because I didn't see, like they have a component of like that, maybe like a domestic or foreign income before income tax?
Yeah, that's a good question. So Mina's saying that table, sometimes people will say, I have U.S. earnings, I have foreign earnings, I have total earnings. They break that out. I'm not 100% sure on that, honestly. It's not a required disclosure in the ASC 740 guidance. I don't know if it's a required disclosure somewhere else and it gets stuck in the footnote. I don't know. Most companies have that, is my experience, and it's sure helpful because so many Silicon Valley companies, that's such a huge driver of the rate, you might as well show it. Yeah. All right, good night.